Trillions of dollars are sitting in a hidden corner of the Fed, and when they move, the entire financial system could erupt overnight. In the quiet corridors of the Federal Reserve Bank of New York, a strange financial ritual takes place every night. Trillions of dollars flow into a mechanism most Americans have never even heard of: the Reverse Repurchase Agreement Facility, better known as the reverse repo. It isn't a conspiracy secret or a vault filled with gold. It's a technical tool so complex that even veteran traders struggle to explain it cleanly. Yet this obscure piece of monetary plumbing has quietly become one of the most powerful forces shaping global liquidity, interest rates, and the stability of the financial system. To understand why this matters, you have to understand how the system was built. The repo market is essentially the pawn shop of modern finance. One institution lends cash in exchange for treasuries, then unwinds the trade the next day for a slight profit. But when too much cash piles up and too few borrowers want it, the Fed steps in and becomes the borrower. That's the reverse repo, a supposedly harmless overnight trade that ballooned into a multi-trillion-dollar refuge for scared capital. For 2 years, money market funds shoveled oceans of cash into the facility, seeking safety from volatile markets and uncertain banks. But that money isn't locked away. It can leave instantly. And when it leaves, the system will feel it. Because every structure built on artificial stability eventually reaches a breaking point, and the reverse repo is no exception. What started as a temporary tool has morphed into a critical support beam of the entire financial architecture. Money managers rely on it. Corporations rely on it indirectly. Global banks price short-term borrowing off its rate. It has become the anchor of the world's safest assets. Yet its foundation is anything but secure. Imagine $1 trillion suddenly exiting the facility and flooding into Treasury bills in a single week because yields become slightly more attractive. On the surface, it looks like a harmless shift from one safe asset to another. But beneath the surface, the impact is violent. The Fed's liabilities shrink. Treasury borrowing surges. Short-term yields swing wildly. Collateral availability shifts overnight. In extreme cases, funding markets can seize. This is not hypothetical. We've seen it happen before. In September 2019, overnight borrowing rates exploded from 2% to 10% in a single day because liquidity was trapped in the wrong places. The Fed had to intervene with hundreds of billions just to keep the system functioning. Today, the stakes are exponentially higher. The reverse repo facility grew 10 times larger than the entire repo market was during the 2019 crisis. Any fast unwinding today would dwarf that shock, and the unwinding has already begun. As Treasury bills offered slightly higher yields in early 2024, reverse repo usage collapsed from over $2 trillion to under $700 billion. What looked like good news on paper was actually a warning. Small yield changes triggered massive outflows, sending tremors through short-term markets. Too much leaving too fast undermines the Fed's tightening. Too little leaving too slowly starves the treasury of buyers. There is no smooth exit path. This is the reverse repo trap. Every move the Fed makes, raising rates, cutting them, shrinking the balance sheet, shifts the incentives for trillions of dollars sitting in the facility. The machine now reacts faster than the central bank controlling it. Add the global dimension and the stakes multiply. Foreign central banks and sovereign funds rely on the U.S. repo system for dollar liquidity. So when American funding markets tighten or flood, currency markets across Asia and Europe move instantly. A drop in reverse repo usage in late 2023 coincided with pressure on the yen and yuan, proof that even minor shifts send ripples worldwide. Yet the public remains unaware. No press conferences explain why $1.7 trillion vanished from an obscure facility. No viral charts show how overnight flows shape your mortgage rate, your rent, your investments. But they do. When liquidity sloshes unpredictably, borrowing costs swing, pensions destabilize, credit availability tightens, and ordinary people feel the stress through rising prices and shrinking opportunities. The reverse repo doesn't create prosperity. It freezes it. Money that could fund small businesses, build homes, or fuel innovation sits idle, earning safe returns, but doing nothing for the real economy. This is why the post-pandemic recovery felt so lopsided. Asset prices soared, corporations thrived, yet workers felt squeezed and small businesses struggled to access credit. Liquidity pumped into the system never reached Main Street. It circulated in a loop between the Fed and large institutions. Stability on paper, stagnation in reality. Worse still, the system's dependence on the Fed's daily operations concentrates risk. Trust shifts from markets to a single institution. And when central trust falters, fragility spreads. The 2008 crisis began with a tiny crack in repo confidence. Now the system is even more centralized, more automated, and more brittle. With digital money and future central bank digital currencies on the horizon, liquidity will become programmable. That offers unprecedented control and unprecedented vulnerability. For individuals, this means three unavoidable realities. Volatility is now structural because markets follow policy cycles, not natural economic rhythms. Savers will continue losing purchasing power as facilities like the reverse repo keep short, term rates manipulated, and asset prices inflated. And independence, financial or otherwise, becomes harder as the system grows more centralized and interdependent. The greatest danger isn't the reverse repo itself. It's assuming it doesn't affect you. The truth is, it already shapes your everyday financial life. And when systems built on confidence instead of resilience finally break, they break fast. The reverse repo is more than a technical footnote. It's a warning, a mirror revealing how fragile the world's most powerful financial machine has become. And when its rhythm finally slips, the entire dance stops.